Hey everyone, Mitch Goldberg here, Client First Strategy. Welcome to Be the Boss of Your Money. A couple of things to talk about. We're getting the live stream done at an unusual time. Right now, it's about 5:15. It's a little bit later than I would ever want to do a live stream, but hey, it's not so bad. You're just probably on your way home now anyway. But we're going to go over a couple of things. It was really important to get this done today. Just one of those days. But you need to ask yourself, should you keep should you chase stocks here? You've been sitting on the sideline, maybe waiting for that recession to hit, waiting for that big swoosh down that, people have been saying we've got another 20% to go to the downside. We haven't reached the bottom yet. This is a fake rally. Don't trust the rally. It's misplaced. Investors' enthusiasm is misplaced. And now you're wondering, should you really trust that? Should you get into stocks now if you've been sitting on cash? Should you keep buying? And on the converse of that, should you be selling stocks? Should you get out of stocks? And we're going to talk about that. And I want to just quickly address the Dow Jones. The Dow Jones Industrial Average is a very popular index. As you know, we follow it. By the way, you can't invest directly into an index, but you could invest into a security that tracks a particular index or mimics an index. By the way, if you want to just trade the Dow, there is a simple way to do that. It's called the Diamond. It's an exchange traded fund. The symbol is DIA, David, Ira, Adam. And it's an ETF that is made to track the Dow. So if you want to trade the Dow, buy the Dow, sell the Dow, as many times as you want to just buy it and hold it, reinvest dividends, you could do that too. But there is a quick and snappy way to do that. That's the good thing about markets, is it gives you the ability to basically invest in anything, buy anything, anywhere, at any time. Just enough to get you into trouble, or just enough to really make a difference and help propel you financially. All right, so we're going to talk about these quick things. I'm going to run a quick intro, and then we're going to get into this. And I hope to be off in about 5 minutes. So here we go. Okay, Mitch Goldberg here. We're just getting started. I am coming to you from a very hot, steamy, and soggy Long Island. It has been hot as blazes here, but I know I shouldn't complain because there are other parts of the country like Phoenix, which I heard they had like a record 11 to 12 days in a row above 110. Not 100-degree days, 110-degree days. I mean, I don't know how you could live there. I mean, it's just, I know this is unusual, but it seems like these unusual events are becoming the usual. We shall see. Hopefully, the weather will calm down, and I wonder how we're probably using up a lot of natural gas stocks to keep all the air conditioning going, to keep all the electricity going. In fact, we are. But a couple of quick things to talk about. The first note, and I think this is going to be significant, is the price of wheat. Now, I don't know if you know this, but Ukraine is in the top 4 biggest producers of wheat in the world. Not as big as the U.S., but maybe their 3rd or 4th biggest wheat producer in the world. Their ports have been basically crushed by the Russians. They can't get their wheat out. Their silos are full from last year's harvest. They're getting ready to harvest this year's wheat. They don't know what to do with it. They can't move it out. And Russia just decided not to extend its deal with Ukraine to get wheat out of Ukraine to the rest of the world through the Turkish Strait. And even though Russia is allowed to inspect all these ships for weapons going in, for weapons going out, contraband or things they consider contraband, they decided, that the Russians, that it's better to make the whole world suffer until they get what they want. But it's not going to happen. And unfortunately, it's going to cause a lot of strife. And wheat prices are skyrocketing. They could double. They could do a lot more than double. And from what I understand, the last time wheat prices doubled was in 2011, which was the spark for the Arab Spring. And when people are starving entire regions, it causes mayhem, it causes war, it causes a lot of bad things and makes big parts of the world pretty miserable. A higher price in wheat in the United States would really not have a huge impact on inflation. Maybe you'd see a loaf of bread go up, 15, 20, 30 cents a loaf. It's an inconvenience, but the rest of the world could really suffer from this. So that's something to keep an eye on. That is, excuse me, my allergies are killing me since we've had this rain. This just happens, okay? But this is something to keep an eye on, that geopolitical events are very hard things to predict. And just when the world is looking at one geopolitical potential problem, another one creeps up that is all the way out of your view. All right. So I just want to get that over with and let you know that's something I'm watching. We'll take a look at wheat prices in a moment. Let's talk about why I still like the Dow Jones Industrial Average. And I'm just going to pop up another screen here. All right. Put myself up here. This is why I like the Dow, because in it you have Honeywell, Visa, Coca-Cola, McDonald's, Walmart, Salesforce, Boeing, Apple, Johnson & Johnson, JP Morgan, Procter & Gamble, Chevron. Have you noticed anything yet? These are different names. We're not just naming the big stocks that basically control or dominate, I should say, better word. The companies that dominate is a better way to say it. The S&P 500, which, as you would imagine, is Apple, it's Meta, it's Alphabet. Meta is Facebook, if you don't know, and Alphabet is the new name. It's Google, okay? It's not that new anymore. I think I'm going to stop reminding people what Meta is and what Alphabet is. Okay? You watch the show, so you know. And then you have NVIDIA, you have Microsoft, and important names. But, the S&P is basically, the S&P reminds me of the NASDAQ like 25 years ago with how it's so dominated by technology. And for all intents and purposes, if you consider Netflix, Facebook, and how they are judged, whether if they're technology or communication stocks, the S&P is, for all of my purposes, it's a tech fund with a smattering of non-tech stuff, but it's mostly a tech fund. So, but then you go back to the Dow, which I'm looking at the stocks right now with you, Procter & Gamble, Home Depot, Merck, a little Intel there, Disney, a little IBM, Cisco. Okay, some more tech, but you have Nike, you have Dow Chemical, 3M Travelers, Walgreens, Caterpillar, Goldman Sachs, United Health, and there's Microsoft. The biggest impact, the way the Dow is judged, is this. I'm going to show you this, okay? You see United Healthcare closed at exactly $500 a share. See that? $500. The Dow is a price-weighted stock, so it's not basically the bigger the company, the bigger its impact is on the Dow. That's the S&P. So the bigger companies have a bigger impact on the S&P 500. With the Dow, it's the higher price stocks have a bigger impact on the Dow. So even though Microsoft, the number 2 stock as far as price goes in the Dow Jones, it's a bigger company than United Healthcare, but because United Healthcare stock is 500, that has a bigger weighting in the Dow than Microsoft's $359 price. So it's price weighted. But the point is, I don't really look at the Dow Jones Industrial Average as an industrial average. I don't look at it as a tech metric, because even though a stock like Intel, I'll scroll to the smallest companies, a stock like Intel and Cisco, which are in the bottom 5 stocks as far as the Dow Jones is concerned. So those little ones have very little impact on the Dow Jones Industrial Average. In fact, the Dow Jones Industrial Average is not an industrial average. If you want to follow the industrial stocks, you follow XLI, which is the Spider's ETF that tracks industrial stocks. Okay, it tracks the industrial sector. Okay, there's 11 sectors of the economy, uh, as according to Standard and Poor's, and the XLI tracks the stocks that are in the S&P 500 that are considered industrial stocks. That's a much better way to track industrials. What I call the Dow Jones is I call it the All American Stock Index because it's American Express and it's McDonald's and it's Honeywell and it's Microsoft. That's why I follow it. It's got Apple. Apple is not the biggest weighting in the Dow Jones because it's only $193. Remember, United Healthcare, it's a small company, but its stock price is more important. This index goes by stock price, whereas the S&P goes by market cap. So Apple is about 6 or 7% now it's about 6.5, 7% of the S&P 500. So they're different. However, I follow the Dow because it gives me to me a better idea of how the markets do. Now, it used to be that the S&P was a more diversified index, and it kind of gives you an idea. Yes, the S&P 500 is basically the index. It's the stock market index that we follow. But it's so heavily skewed toward technology that I find I'm getting more use now out of the Dow Jones Industrial Average because it gives me an idea of what else is going on inside the stock market in the internals, as opposed to just the S&P going up because Microsoft hit an all-time high today. All right, so that's why I still follow the Dow. I think it's still a pretty useful index. It wasn't that useful, but it's becoming more useful again because it has Disney in it, because it has Caterpillar in it, because it's got just different kinds of stocks, and it's not so weighted toward the tech stocks like the other one, like the S&P 500. The NASDAQ, strictly a tech index, in my opinion, strictly. All right. So let's take a look at some of the market averages here, okay? We have some of the big movers: Schwab, Morgan Stanley, Netflix, Mosaic, which is a fertilizer company. They're obviously not sourcing their fertilizer inputs from Ukraine or Russia, so they'll be able to charge more for their prices. Lockheed was down, but different types of companies were down: Charles River, Extra Space, Lockheed Martin. Okay. Bond yields were modestly unchanged today. I wouldn't, modestly, very little movement in the bond market. But here's what I'm talking about before. Wheat continuously goes up. Let's just take a look at the chart for wheat. Whenever that chart comes up, this is wheat coming out of the pandemic. It came down, but I think it's starting to go up again. This was that whole inflationary thing. Remember when inflation was running at like 10%? That's when eggs, were shooting up, and other commodities were shooting up. Lumber was shooting up, but the commodities complex has come down. Wheat, though, is really just a geopolitical football now, and it's being played by Russia in a very inhumane, horrible way. And there's going to be a lot of dead people around the globe from starvation because of Russia. All right, so that is that. Now, so the big question: market's up a lot. You've been listening to the pundits, and I have one particular friend of mine who's a client. He's investing a really pretty serious amount of money into his account every month. And it's a sizable portfolio, and he's been asking me for the last year or so, shouldn't we wait? Why don't we just get out now and hold on to the cash? And I told him that's a terrible idea. He's young, under 40, and has a long way to go. And I said, stick with it because we could go a lot higher. We could go lower, but that's why we're dollar cost averaging. And I told him point blank, I can't predict if the market goes higher or lower over the short term, but we're investing for the long term. So what's the point? Should you chase the market, or should you trim back stocks? Should you chase them? Should you trim them back? If you're already in the market, maybe you trim back stocks. If you're not in the market, maybe you buy slowly. Could that be the trick? I'm going to give you a better answer. Think of it this way. The stock market is a tool. Individual stocks or mutual funds or exchange traded funds, these are merely tools. And these are tools that are supposed to help you build a portfolio which is supposed to help you build a future, a financial future. So, is now a good time or not to buy a hammer? Is now a good time or not to buy a screwdriver? That's how it sounds to me when somebody asks me if they should buy stocks now or sell stocks now. That's how, to me, how silly it sounds. And I'm not trying to knock anybody for worrying about if the market's going up or down. But for all those people who waited for the market to go down, all those people who waited for that recession to finally come, for all those people who listened to the naysayers saying, we are not out of the woods, inflation is still going up, the Fed has to raise rates a lot more, and these things could yet come true. But so far, we are just a few mere percentage points away from hitting new all-time highs in both the S&P 500 and the Dow Jones. And based on how the Nasdaq's doing, that could be there in the not too distant future as well. So should you wait or should you not? Okay, again, we go back to, if you're building something, you need tools to build it. You're building a house. Is now a good time to buy lumber? Is now a good time to buy the hammer, the nails, the saw? You buy it when you need the tools to build the house. And if you're going to be in that house for a long time, it doesn't really matter what price you paid for the hammer. It's not going to be that much higher, and it's not going to be that much lower. I don't ever recall hammers going on sale at Home Depot. But then again, saying that might then again, by saying that, maybe that makes me dumber than a sack of hammers, but I think not. I know that what it takes to be a winner in the stock market is not intelligence. It's patience. It's the ability to be optimistic. And that's one of the reasons why I think the stock market is one of the greatest wealth creation tools there are. So think of stocks, exchange traded funds, mutual funds, in whichever form that you could purchase them. They are merely tools to build a portfolio to help you build a financial future. Nothing more, nothing less. Thanks for watching. I really appreciate your time, and I will be back tomorrow. Have a great day.